In this video, we're going to be showing you how you can do covered stock on Thinkorswim. So this is basically shorting 100 shares, buying a call, or on the other hand, buying 100 shares, buying a put. So again, you can trade with defined risk. So to get straight into how do you do it, all you need to do is go over to the trade tab. So again, just basically the option chain. And then what you're going to want to do is you put this where it says spread. It will most likely be on single. And again, you can just come down here and change this to covered stock. Now, what this will do is if we go down to here, and again, firstly, you need to obviously know, do you want to be shorting it or do you want to be buying the shares? For this example, we'll use Palantir. So this is a stock I would consider very overbought. You can see from how I do technical analysis, it is overbought. So to me, I'm looking at a 1 to 2 point pullback to be able to trade on Palantir. So what I'm going to look is obviously trade spread covered. Look out for about a 20 to 30 day expiration. So we'll go out 20 days, or actually we'll go out 27. And then again, what we would look for is where do we think it's going to be below. So again, right now it was trading at about $13.85 in the after hours. So what we'd be looking at is probably having a defined risk above $14. So then what we do is we come over to here. And again, if I'm looking to short the shares, I'm looking to hit the bid. So what this will do, and again, just delete that and show you again. If we click there, what this will do is short 100 shares and buy a call. So again, if we go over then to the Analyze tab, again, you can see exactly what this means. It means your defined risk on this trade is going to be $111. And then again, the further it goes down, the more upside you have. Now, again, this is going to be down to the credit. And this is why you may want to get into the trade this way. Because obviously you can short the shares and then just go and buy the call to hedge your risk. But the real benefit of doing it this way is you can kind of get a more ideal entry. So for something like this, let's say I wanted to get in and only have $100 max risk. What I can do is again put that to a $13 credit, and again you just got to go to the strike and then change your price in comparison. Obviously now there's only a $1 difference. That means we have a $100 max risk, and again just put that lock on so it doesn't change, and then you can see we have $100 max risk, and then if it goes in our direction we can make the money. And then again all you would do is basically just do confirm and send, and then you can send the trade out like that. But this is one really good way to do it, again, just for that main being that you can kind of control your overall entry. Sometimes you got to short the shares. Again, you might short them at say $13.50, and then you have to go and buy the call, which again, sometimes you don't know how big the spread is going to be, especially if you're not trading super liquid options. So in this case, you can kind of get your exact defined risk going into the trade, and then obviously your risk is defined until June 23rd in this case. But again, if the call closes in the money, then obviously your shares will be covered. You won't have to do anything. And then if it closes out of the money, then you can just buy your shares back naturally to again then get out of that, because you no longer have a defined risk. So that's how you can do it if you're trying to short the shares, buy the calls. And again, basically the exact same thing you can do on the puts. For example, let's say PayPal, for example, I want to be more long biased. The only reason I say that is because it has recently sold off. Probably not something I'm actually long biased on, but just for the example. So we can say it's at around $60. We can say if it's below $60, we want to have our risk defined. So again, then what we can do is go over to the puts. We can look to buy the puts. And again, what you can see here is it will buy one put and it will also buy 100 shares. And again, then if we go over to the analyze trade, we can see what is your defined risk. Your defined risk in this case is $236. And then again, if it goes to the upside, you've basically got the unlimited upside. Now, again, you can kind of pick your precise entry. So let's say you only want to risk $200 on here. What you can do is change this to $62. Again, the difference between the strike and the price. So that's a $2 difference now, $200 defined risk. And again, this can be good, especially if potentially the options are quite volatile or the spreads are quite wide. Putting the orders out like this, you can kind of get those good fills when it goes in your direction. And then again, the main reason I like it is you know exactly how much you're going to lose before you even enter the trade, or can lose before going into the trade. So that's how you do covered stock, whether you want to short the shares, buy the calls, or you want to buy the shares, buy the put. So I hope you enjoyed the breakdown. If you did, why not drop a like and subscribe? And if you want to see the strategy I trade, why don't you check out this video here.